This is Las Vegas Real Estate Now, where we bring you the 3 E's: educate, empower, and engage. I'm your host, Harvey Blankfeld, and we've been selling homes here in Southern Nevada since 1988. We have Bill Nelson and Jeff Edwards from Piercy, Bowler, Taylor, and Kern. You made an interesting comment before we started the program today that there's a way to make a company look like it's doing very, very well, and there's another way to make it look like it's maybe not doing quite as well. Can you talk about that a little bit?
Love to. Well, under IRS regs, businesses are able to deduct fixed assets or property and equipment that they acquire.
Right.
Let's say a company buys a computer system or a bunch of software for $20,000.
Okay.
They can, under Regulation 179 or under other bonus depreciation, they can expense it all in 1 year.
Okay.
If certain conditions apply. Well, on the financial statements, that's not allowed. You can't deduct it all at once. It has to be amortized or depreciated over a period of time.
Okay.
So it'd be depreciated over, say, 5 years.
And this comes into play really when you, in a big picture, let's think of a construction company that buys a bunch of construction equipment each year.
Sure.
You can use Section 179 expense to expense up to $500,000 of asset purchases. There's another principle that applies. Let's suppose that you have a bunch of prepaid assets on your balance sheet. Mm-hmm. Prepaid rent. In gaming companies, we have a lot of prepaid expenses that have to do with the gaming. Well, for book purposes, you've got to record that as an asset, which bumps up your income. Mm-hmm. For tax purposes, we can expense that in the year, so that drives down the taxable income.
Interesting. What I want to talk about now, though, guys, is taxes, just taxes in general, and new tax laws. Tell us what's going on with taxes right now as we speak here in the middle of 2017.
One of the things that President Trump wants to accomplish this year is ending the estate tax.
Right.
Another name for that is the death tax.
Right.
Right now, there's an exclusion. Let's suppose that you've got a $10 million estate. You can subtract $5,490,000.
Okay.
From that estate, and then you're only taxed on the rest of it.
Got it.
It would, and the tax is huge. It's about 40%.
Okay.
So if you've got a $5 million estate, a taxable estate, and you look at 40% of that, you're looking at a tax of $2 million. Wow. However, we don't know if we have the votes in the Senate to get it by. There's a 60 votes needed to get by a filibuster.
Okay.
And we don't know if we have 60 votes to get by that filibuster.
Gotcha.
And then, but they could do a bypass on it. But what we're looking at is it might be able to get by if we could call it a overall tax change. Mm-hmm. And so it's not going to decrease revenue because we've got other taxes coming in that it's going to offset it.
Okay.
We might be able to bypass that filibuster. It would be nice to be able to take that off. I would love to see a VAT tax.
Really?
Yeah.
Value-added tax.
I would love to see that.
Mm-hmm. Okay. Explain that. Explain a VAT tax.
It's really just another sales tax.
Okay.
If we could decrease our income tax and bring in a VAT tax, then like you said, we have those people that aren't declaring their tips. That they've all got to go out and buy something.
Right.
Then they're paying tax. We have all international tourists coming in.
Right.
And they're buying stuff. Then they're paying our tax.
Right.
We have a lot of people that are working under that aren't paying tax.
Right.
VAT tax. Then they're paying their tax.
You've been listening to Las Vegas Real Estate Now with host Harvey Blankfeld. Please tune in every Saturday at 11 a.m. right here on News Talk 720 KDWN.